Hi, I'm Mikey. This is Tyler. We're the founders of Innovative Start Organization, a nonprofit that teaches financial literacy. And with these videos slash episodes, we try to inform you guys on financial and economic impacts. Today, we're going to be revisiting some of the things that we've been talking about over the last few months or so. That being some of the Fed interest rates and some announcements over just, some things that might be economically of importance to you guys. So we'll talk about how that impacts you as an individual, whether you're, house shopping, getting ready to, start saving. Obviously, it's gonna anybody that's just a working individual in that sense. But yes, uh, recent announcement on the Fed interest rate. It looks like the new range is going to be between 4 and 4.25%. Um, I don't know if Tyler, if you can elaborate on like basis points. I know when they say that, that probably just goes over a lot of people's heads, and they're like, yeah, they're like it's moved this much basis points or whatever. But I think that's like something that's really like oh, what does that mean or whatever. But we'll jump into that.
It's
And I'll let you
sexy
go.
talk.
Yeah, I think it's
Yeah.
I think
It
it's
just
go ahead.
no, I think we're about to say the same thing. It just makes it seem like it's a bigger, not a bigger deal, but like a better way of saying it. I don't know. Like, for example, because the interest rates don't move as much,
Hmm.
I think they say 25 basis points to emphasize. So like instead of saying the new range is between 4% and 4.25%, and it went down 0.25% or a quarter of a percent, they just say like 25 basis points. So, again, the finance lingo, we this is one thing that you and I spoke about whenever we were first getting this financial literacy thing, us
Hmm.
personally, is like these words and phrases are so intimidating, but it's not that deep. So just some encouragement there.
Yeah.
Because they're not gonna most likely in a normal economy, they won't increase or decrease by one whole percent. So they'll
Right.
do like half a percent or a quarter of a percent, and that's where
Also known as like easing. So if you really take a look at it as far as like what they have and then what they base their information off of and things like that. So obviously they've been trying to hold it steady as possible. The Fed's job is, largely just to prevent any type of recession. I know they hate that or the R word that comes out of there. That's what they try to avoid. So anything to one like slightly because I thought I was saying you can't make a large impact because a lot of the things that they base their numbers off of are always changing. So they do like slight adjustments here and there just to see like okay, we'll do a little bit of this and then see if it, teeters a little bit that way. So um just to kind of like really simplify the explanation, but it's not like when they make these announcements, like, yeah, this is going to be the, extremely huge change that's gonna like shape the economy one way or the other. Because that would just be a disaster. Because then next time that they have to make that adjustment, it'll have to be significant that way in this way. So better to hold steady than to cause complete chaos in that sense. But yeah, like some of our notes here just talk about it being a balancing act essentially. But yeah, talking about how it impacts you as an individual. So obviously, when they make these adjustments, it trickle down to a lot of different things as far as like one for you financially, and just what you'll see, across the whole economic kind of factors that we will take a look into. So credit cards and loans and all of those things um, will kind of impact like the rates around there. Also like mortgages too as well. Tyler, I know you could probably speak more about that too. I don't know. Do people, whenever you like, I guess talk in like a real estate sense, whenever they talk about some of those Fed interest rate changes and things like that, do people ever come up to you and just, or is that something that you guys discussed at all?
yeah, you got to be careful as a real estate agent not to talk too much for financing, but basically the 10-year yield of um, the government bonds,
Hmm.
that is an interest rate that fluctuates depending on demand, and most of the time, depending on how that does, is what the average 30-year mortgage goes off of. So it's really sometimes it can get confusing. So you like what we're talking about, where the we have the Federal Reserve, which is a
Hmm.
governing body of people that is outside of the United States Congress,
Hmm.
and they watch all of the economic indicators like employment, rent payments, um, milk costs, grocery bills, everything, and then they adjust the interest rates based on those things. And then you have the open markets of government bonds, which essentially says, hey, if the interest rate is at such and such percent, we're going to buy these bonds for the government or we're not. And normally, whenever, you were an accounting major, I was a finance major. Whenever we're in like our beginning level finance classes, they teach you that 30, or I'm sorry, the government, United States government treasury bonds are one of the most safest assets, because you can, if you have a 4% bond for at $1,000 or whatever it is, you can calculate that pretty easily. You know the return you're going to get at the end of that bond. Versus if you put in the stock market in 1, 2 years, you don't know what the actual amount is going to come out. If that makes sense. So you can measure it. You know you're going to get what you're going to get, and they're seen as safe. And then that 30-year mortgage rate bases itself for the most part off the 10-year treasury bond. So there's a lot. Bonds are really uh, boring and not fun, but they are the basis of our economy. So if anyone's really interested in learning like the foundational stuff, I would just be a nerd about bonds. It's no fun, but if bonds start going crazy, that will have a huge effect on our economy. Also, another thing I want to say real quick, I don't think we have enough time now, but to review this, but time value of money, like I
Hmm.
would look that up because that plays a role in interest rates and why we even need to charge an interest rate,
Hmm.
things like that. So
Yeah, I think
that answers your
the recent tariffs have played a significant role as far as like concerns within that the adjustment of the interest rates too as well. Obviously, there's concerns around inflation, um, and those are one of the significant factors when you look at like recessions. So essentially, again, the balancing act of adjusting the federal interest rates comes with all of those factors like Tyler was just talking about, right? From the minuscule stuff of like, the prices of certain, grocery items to large items like, how much it is to import and export some of the goods that we have. All of that plays a significant role. And if the case is that they see something like that, right? That's how they adjust up or down for those basis points, as we were talking earlier. One of the things I would like to highlight is a savings account. So, if you have like a CD or whatever, some type of savings account that is having interest on it, this is where you see some of that direct impact to you right away, right? Your interest rates or however much the bank is giving you, whether that's like 3%, 4% or whatever. Sometimes it's on par with that, if you find a good one, right? But essentially, if it lowers, that impacts you versus if it raises, that impacts you, right? Obviously, you'll make more money if the interest rates are higher. If it's lower, right? Some very simple stuff that you can just get right away once the announcement's going. It's like, hey, I have this CD or this high yield savings account. This is where it looks like it's gonna make some impact. Um, Investment, and it's tricky. I think market volatility is just there could be a string of things. I think a lot of times people say like, oh, the Fed interest rate will make or shape, how the market reacts. Like maybe for like a day or a week or whatever else. But I tend to see that there's other, impact to the market outside of federal interest rates. Obviously, depending on which way they go, can shape and shift what people invest in, right? But you can also take a look at the market as a whole, and depending on what you're investing in, maybe there's no significant impact from the Federal Reserve's adjustment. So I think that's one thing. Yes, and then another significant thing here is lower interest rates can make the U.S. dollar less attractive for foreign investors when it comes to our currency. That also just talks more about into the inflation and yada yada. Obviously, we want the dollar to have a significant carrying value. Back then, it used to be tied to gold. When you talk about fiat currency and all of that stuff, like what is it tied to? I think it's a lot of times when you if you talk to somebody about crypto and all that, like there's always two sides of it, right? Because people look at crypto and they're like, it doesn't make any sense. It doesn't. But if you talk about the current dollar bill that you hold in your pocket or whatever else, like you're on the same terms of it, essentially. Um, it's hard to say because it's no longer tied to that commodity anymore. You know, how does it actually carry value? And that could be this, the same for any currency around the world. But how do you add value to that, right? Obviously, your economic power and everything else can be tied to that. You see, you'll probably do studies about countries. I don't even think you. I think that's something that's just done like at a history level. If you talk about countries like uh, their value of their dollar or whatever being so inflated. I think we talked about it about in I think it was World War I or two, like Germany's dollar was so inflated and them having to pay so many people back and yada yada. But you will come across that. You probably will, you'll breeze over you as far as like, oh yeah, like that. But that is very significant today because if anybody talks about the power of a dollar, time value of money, anything along those lines, inflation, like all of those words mean things because it's, how powerful is your dollar today versus tomorrow versus yesterday? Um, can you buy the same things, right? Uh, you, if you ever hear about, oh, so and so was paid, $1 million or whatever, or they bought a house for, $100,000 back in the 80s, 90s, right? And somebody's okay, what's that worth today? Or like, how much was that, transaction today, right? And then you get there, you're like, wow, that's a lot of money. I think what happens is that you can see how it changes and shapes and everything else because throughout those years, um, interest rates have varied as far as like the Federal Reserve what they've done over the past 20, 30, 40, 50, whatever it is, since it's existed. So essentially, like I said, pay attention to those things. It's simple. I know they use all these like weird words, like I was just talking earlier, like basis points, um, treasury bonds, bond market. Bonds are probably like when I was in those economic classes, most boring thing ever to me. When we start talking about bonds, I'm like, you lost me. Start talking about
100%.
a yield curve. I'm like, yeah, but you lost me. We were talking about that yield curve, and I remember all those exams, and I'm like, they're like, if this happens, that yeah, you got me. But in reality, like those classes are extremely significant because you learn a lot. And I think that was mostly just in like I think my macro economics class because macro has to deal with like um, the economy as like a whole versus like micros more so on like the business level and such. But extremely important. I feel like that should be a class for anybody, no matter major or grade wise. Trying to think of what else here. Um, but yeah, one of the other things here is stimulating the economy. So um, by making the borrowing cheaper for consumers and businesses, um, they hope to boost spending as far as it goes, or how much people are investing. Um, Again, when we were talking in past videos, GDP is an important factor that plays a role in, how we're seen as the U.S. as like an economic power, right? But obviously, when they make those adjustments, they're doing that for the factor of always, always, always. Because I think when it comes to the R words, also known as the recession, whenever consumers are unable to spend, one of the other significant trends that we've seen and Pat and I have discussed is people carrying debt and also taking on more debt. So you have credit defaults and all of these things that are becoming very significant now, and that curve is jumping higher and higher each time. And when you look at the factors of, okay, what is it that could be impacting that and all that, those are other factors that we talked about in previous videos. So I would say some buzzwords that you can take from this that as you're watching this video. Um, One, inflation, time value of money, Fed interest rates, more or less basis points, if that's something that you wanted to look at. And then just looking at some of the things too, as far as like the history behind the Federal Reserve. And a lot of people are like, oh, we've said this countless times. It's a governing body, but it does not work for like the government or with the government in that aspect. So please just, a quick Google search. Use that to your advantage, I would say. Anything else on that, Tyler?
Yeah, I would. So there's a lot that came out of this. Time value money,
Mhm.
the history of the Federal Reserve. One thing, because everybody's giving these, boomers a hard time of like, y'all got all this money in retirement and you bought a house for $50,000 and now it's worth 1 million or whatever the exaggeration is.
Mhm.
But the reason is because what we're measuring the house in, excuse me, has gone up in supply. So the reason
Mhm.
why a Bugatti or certain Ferraris are valuable is because they're like one of five, right?
Mhm.
If we pumped out a bunch of Bugattis or Ferraris, they wouldn't be as worth much. That's how the
Mhm.
US dollar works. So how do you balance this? I don't know. Like in COVID, whenever we printed or we created 40% of all the dollars in existence in a few years, that's why things started going up in price because there was more dollars that were chasing
Mhm.
goods, groceries, cars, houses. We saw that a lot with houses. This is why there was some large individuals, won't name names here, but there was one individual that became like the second or third largest landowner in the United States because this certain individual knew that they were going to print a bunch of money and inflate things, and that's why they bought hard assets. So that's where hard assets come in. Like, that's where you're talking about gold and houses, and this is where some of the crypto people come in with Bitcoin, how it's finite. So
Yeah.
there's a lot of nuggets in here that I would personally go through. And every just all you got to do is just ask AI,
Mhm.
like any AI service, hey, what does the Federal Reserve do? How were they created? What is the
Mhm.
history of the Federal Reserve? Who gave the Federal Reserve power? Congress enacted the Federal Reserve Act, from my understanding, in 1903, I believe it was, early 1900s.
Mhm.
Um, that's an interesting and kind of sketch story in itself, but
Mhm.
again, we're not here to persuade. It's just my personal opinion. So go take forth what that's worth. There's a lot in here. We should not
Yeah.
have enough time to get into.
No. And just kind of to wrap up on what Tyler says in our video as a whole, um, yes, and that goes back to the simple things of like just economics as a whole, right? Supply and demand. Um, if I have a bunch of money to spend, right? Obviously, the person that's selling me something is also going to see that and they're going to raise their prices. Because why would they keep prices lower when they know they can get more money out of you, knowing that you have it, right? Or versus like, if there's a bunch of it, like think about buying a pencil, right? You get you 100 pencils for cheap. You get you a pencil there, you buy a pencil on the street. In that sense, like there's no significant value of it. It's not gonna change how much it's gonna cost now, unless like wood or lead or whatever else that goes with graphite or anything else along those lines change. You're not seeing anything from that. But as I was saying, like the housing market and everything else, like if there was just this extreme oversupply in housing, which I think we're getting to like a point there too as well. But then there's also other factors that play into it, like large corporations that buy up housing and make it for renting and things like that. So reality is, do your research, look into those things before you take significant advancements in like some of the things that you do financially. Just really just sit down, do a little quick little study on it and be like, okay, now I can know a little bit more about this and better, approach this situation. Um, but I will say the most important thing out of that is just really supply and demand. Like when you learn the science class, the cause of the IV on the DV or whatever it was, you gotta like it's gotta be in the back of your toolbox right there as far as like just understanding those things. So um, again, some of those buzzwords we talked about, take a look at those. Let us know in the comments if there's anything that you feel like you've learned outside of school when it comes to the economy, some of those buzzwords too. If you have any significant tips or tricks as far as just like understanding certain terms and topics and things that get discussed as a whole. And yeah, if you have any ideas as far as like of what you want us to talk about in our next videos. But that is all from us. Tyler, anything from you before we wrap up? All right. We appreciate you
Good
guys.
stuff today.
Yes, sir. Like, comment, and subscribe, and we'll catch you all next week. Thank you.